The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I'm Warren.
This is Pieter Villiers.
Today we're talking about something that's very close to both of our hearts, which is about financial planners. And you've got a nice catchy topic for this one.
When to hire, fire, or DIY?
So before we get into it, thank you to Sealand for sponsoring our kit. We appreciate it, especially when it's so chilly. So I mean, maybe just at the start, both of us have pretty strong views that we think financial planning is good. But having said that, we don't think financial planning is required for every single person in the world. There are people. And there are a good number of people that might well be able to do their own financial planning or might need some help sometimes, etc. So, I mean, I always like, because it's honest money, I think we need to be transparent. You and I are financial planners. So if you want to criticize us and you think we're biased, that's your deal. If you listen to the whole episode, I think you'll figure out that we might surprise you with how unbiased we are around this topic. So maybe just to kick off, I mean, I don't think there is one approach that works for everybody. When it comes to how you invest, how you save, how you do your insurances, how you consume advice. I mean, you might consume advice by actually studying the stuff and becoming your own advisor, or you might be on the other end of the spectrum where you say, I don't want to know about this stuff at all. And in which case, we hope you're listening to the show because you just need to know some stuff. You can't just do nothing. But there might be people in the spectrum from 100% on their own, doing it themselves, to 100% advised, and maybe in between.
Yes. Yeah, you get your validators and your delegators. So I think probably if you are a normal kind of person, career progression, you're probably going to go through all three of these choices in your life. At some point, you're going to want to DIY stuff. At some point, you're going to want to hire advisor. And at some point, you might want to fire your advisor. So that might happen. It certainly happened to me. So I think let's maybe start with the DIY. What can we, as normal education, normal people that can provide ourselves with education, what can we actually DIY in a financial plan and what can we not? Because there are some stuff that you probably won't have to or will be able to DIY. So and again, we just to reiterate what Warren said, we're sharing our personal views on this and we're going to try and be as objective as possible based on our own experiences and what we're trying to convey. And I think both of us are very passionate about education, and hence why this podcast exists, and Warren has written many books on this space. So we just want to kind of guide you as to what we see be most appropriate. Right, so let's say you're a DIY investor. The type of person that would be suitable for that approach is someone that does have firstly the time to be able to invest in education and learning about money. You watching this video, reading articles, reading books, really investing time into your own knowledge. And also the willingness to actually manage your money yourself. I think when it comes to investing is not that difficult that I think the industry would like us to believe that it's so complicated that only a professional can do it. I don't think that's true. If you are young and you have to know some basic things to get started, type of investment vehicles, funds to choose. But your investment strategy could actually be fairly simple. We've touched on this a couple of times. Maybe one ETF, one type of index fund for a specific purpose, that should be fine if you're young. What I would say is if your wealth grows to a point where it gets very dynamic, it's very diverse, you've got assets on many different places, maybe you were a DIY investor and you've built it up to that point, but then things become quite complicated. And you might be very strongly skilled in investing, but you're lacking skills and knowledge on stuff like estate planning, which forms part of investment plan. It's very important. Every decision you make on investments affects your estate. I've seen a lot of times DIY investors that are doing very well for themselves. They get to a point in life where either they realize, the more I learn about stuff, the more I realize the little I know. That's a very true thing about professionals as well. but they either come to a point where they want to consult a financial planner to make sure, looking at my holistic picture of everything and telling me, cool, Pieter, you're on the right track, or Pieter, you've missed this. This is your blind spot. We need to look at this. And even for us as financial planners, I think we also have to be honest to say that we have our own confirmation biases. We've got our own preferences in the way we manage our own money, especially when it comes to emotional decisions. So sometimes a financial planner also needs a financial planner, not because they lack the knowledge, but because they need that thinking partner to add value and to look at the picture holistically, especially if you are married, to also take your spouse's wishes into account. Because if you run the household finances, you're probably going to invest it according to what you think is best. And sometimes it's good to just have that external either validator or thinking partner to guide you in the right direction. The other thing that I think also what I see is, let's say one of the partners is the one that generally manages the finances. They've built up everything and they believe they know everything about the finances and they'll be okay. But then something happens to that partner. They pass away. And now spouse that hasn't been involved in this process doesn't know what to do, because now everything gets dropped on them and they haven't been made part of this process. Then it also makes sense to work with someone that can speak to both of these parties and make sure both of them are in line with what needs to happen. So as a DIY investor, you can learn a lot about investing, for sure. You can create your own investment plan. I'm a big advocate for that, because you're probably going to save money. Doesn't mean you can't consult professional help, because I think you should still, at some points in your life where there's big transitions, getting married, having a child, getting divorced, your spouse passes away, definitely makes sense to consult a financial planner. Maybe at that point, the value that they'll add is more on the estate planning side of things. Things like insurances is not something that you can generally take out yourself. I guess you can go directly to a company, but someone needs to do a calculation, which is a bit more advanced than an online calculator can do for you, because there's a lot of taxation and laws that you need to understand that you probably don't have time for. And when it comes to legal stuff, marriage contracts, wills, definitely don't DIY that, please. Trusts. You need to consult a professional, and this might be a financial planner, might be a legal expert, might be a tax expert. It pays to pay for good advice, because it's either probably going to save you a lot of money or prevent a lot of issues in the future. So we're all about the education, and that's what we're advocating for. But it doesn't mean that you might not get value from good financial advice. That's my take on the DIY.
Well said. Was that just DIY? I think the short-term insurance is, for me, a very interesting parallel to the financial planning industry, because you can go direct to a direct insurer and get insurance for your car and maybe for your household stuff. And if you put in the time and the effort to understand what's being sold, because remember, they are sales companies. They're not just sitting there waiting for you to call. They're advertising to you all the time, trying to influence your decision making. So you can get direct insurance on relatively simple items. And if you get enough quotes and you do the homework, I think you can end up making a fairly good informed decision on your own without being an insurance expert, and you can probably get a decent outcome. At the same time, if you run a complex business where you're importing, exporting, you've got staff, you've got premises, you've got machinery, I'm sure there are direct insurers that will tell you all you need to do is phone our call center and speak to one of our people that's been trained for 3 weeks, and they'll help you out. I'm not sure I want to put my entire business at the mercy of a person in a call center that's had a few weeks of training. Yeah. So that might be unfair on them. That's fine. I would rather then consult someone that's got deep knowledge, that is an industry expert in what I do and what I need, and then help me. So you'll find that now we're on the spectrum of complexity and knowledge and size of assets and all of those things. So I think there'll be a middle ground as well. So you might find people will engage an insurance agent or an insurance broker for insurance around their business. But when they insure their car, they're happy to do it themselves. And so they'll use a spectrum of services. And I think financial planning, financial advice as a whole, is very similar. it ties into you as the individual. How much work do you want to put in? How much control do you want to have? And how much knowledge do you either have or are you prepared to get? Uh, and what I find is that we can segment people psychologically as well as by age and size of assets and all of those things. So there are people out there that are absolute control fanatics. They want to control everything. They want to know everything. They're going to put in the time and the effort, and they're going to research to the nth degree, and they're going to implement their own decisions, and they will live and die by those decisions. Those are DIY personalities as opposed to size of assets or something. And it's not a judgment that they're right or that they're wrong. That's their personality. That's their wiring. And so for them, education and literacy and an enormous amount of homework is required. So I don't discourage people from doing that, because someone who's got that personality, they're going to be desperately unhappy if all of their investments and all of their insurances and all of that stuff is being managed by someone else, and they don't really know to the nth degree what's going on.
Yeah.
And so that's not a marriage made in heaven. That's a disaster waiting to happen. Someone's going to be unhappy somewhere. So I think psychologically you've got to understand yourself as well. I mean, a lot of the time this will come up around fees only. So someone will say, I want to save money, I'm going to do it myself. I've just given you all the reasons why that's okay, provided you do all the work.
Yes.
If you want to save money but you don't want to do the work, you've got to be honest and say, well, that's fine. Save the money, save the advice fees, whether it's an hourly fee, a fee for a plan, a subscription, or an ongoing fee, doesn't matter. All of those things, you can save money, but you could make some really tragic mistakes. And that's what I think people miss out on in this whole thing. Money is a part of the equation. It's not the sole thing. And I've seen people over long periods of time do phenomenally well on their own. And they're happy. There are lots of advisors who are very happy that those are not their clients because it's just not a good match. However, I've also seen lots of people that say, I can do it myself. And what happens usually is, let's just talk about investments. The markets go down. We have a big, pandemic, financial crisis or something. And the person that's been doing it themselves suddenly realizes their psychological tolerance for risk isn't what they thought it was. They don't know that. That's not the thing that happens. What happens is they wake up in a blind panic. There's flashing red lights in there behind their eyes. They sell everything in sheer panic, and they cause financial destruction. And those are people that would have done incredibly well with advice of some description. So I think it's about knowing who you are from a hardwiring point of view, understanding the amount of work you have done or should do, and then the tolerance for when things go wrong. The tolerance for, and it won't be, I'm not saying a mistake, it's when things go wrong in the world. The world happens, it's going to affect your money in one way or another. And so, I mean, the DIY people, I think good advisors love having short interactions with DIY investors because it's a nice engagement. But good advisors don't really want DIY clients as clients either. So it's understanding that it can be a very almost transactional relationship. I'm going to sit with you. I'm going to talk to you. I need some help. You're going to help me, but we're not going to see each other again. And if everyone's clear and transparent about that, that's great.
Yes, it's a business model that can service that type of market. To your point there, time is also money. So learning all of these things, I mean, to become a CFP, a certified financial planner, it's 3 to 4 years, depending on the route that you go, with a postgrad at the end and quite a vigorous exam to learn about everything, I guess, you need to know about money. Now, if you are another professional, medical professional, legal professional, CA sometimes, even if you work in finances, yes, you can spend a lot of time learning about these things, and we will always encourage that. Just understand that your time is worth something, and if your time is worth a lot, then you can go and make the calculations. If it's going to take you 100 hours to learn how to manage your own money, how much will that equate to rand value, and how much would it cost to pay someone to help you get there quicker? Whether that is a once-off plan to get you started and you can continue managing it on your own, or an ongoing service where every year you pay a fee to have that thinking partner, whichever need you have. That is the easy one to look at, but there's also time spent with family. quality time with your family. Because, you know, if you're working the whole day and now you get home and you've got kids and you're spending the rest of the time trying to figure out your own finances, that's quality time that you're losing with your family as well. You can't really quantify that into a rand value. So it's always good to educate yourself. Again, for everyone, you need to have that baseline of information. If you are one of those personalities, I certainly am, to want to know as much as possible, and it interests you. You know, if you're one of those weird guys that reads financial blogs for fun, you know, that's probably you.
Those are our listeners and our followers. We don't think you're weird. We thank you very much. We like you.
Weird like I am. It's a good weird. It's always going to be beneficial for you. Just don't get too kind of almost obsessed about that, of cutting all fees out, that you become oblivious to the fact that someone might actually add value to what you already know. Because believe me, the more you learn about money, the more you realize the little you know. I think that's certainly for me was. So those are DIYs. Now, you also get delegators. So a DIY is someone that educates, they have the time and they're willing to spend the time to learn about managing their own money. And they get to a point in life to a large extent of doing that. But maybe then they do want to consult a financial planner just to look at everything to validate what they've done. So maybe they're not interested in an ongoing relationship. They just want to speak to someone, look at everything, tell me what I do. It's like going to the doctor for a checkup. You know, you not necessarily have to go to the doctor every month. You go once a year or once every couple of years whenever you need it. Then, you know, there's financial planners that can help with that. The next group is delegators. Now, these are people that maybe they do have some interest in understanding the basics, but either they don't have the time to manage their own money or they don't want to. They kind of want to make sure that someone needs to tell them, you will be okay, and they will handle all of the responsibilities. They kind of delegate that role to a financial planner. So I think the most people fall within that category, in the delegation.
Yeah. I think that's true. I mean, you know, in my experience of dealing with clients over a long period of time, I found that it's probably delegators are the biggest grouping, and then the DIYers are the second biggest grouping, and then the last grouping would be people that are somewhere in between, that they kind of take from a menu of advice or information when they need it. I mean, I like your medical example, because I always think the GPs, general practitioners, they have the worst pricing model I've ever seen. I would love to pay my GP a monthly retainer. And the deal there is keep me healthy for the next 30 or 40 years. I don't want to come and see my GP only once a year just to do my blood tests or whatever it is, the medical exams, or when I'm sick. Because I'm arriving because I'm sick, because a problem has happened. What I'd love is for them to you know, if it's on my watch where they can, you know, get a download of my heart rate every night or every day or whatever, and something goes wrong, and then they say, hey, you're not sleeping enough, or take care of this, or, you know, your Wi-Fi scale tells me that you're putting on some weight. What's going on? You know, I would love to pay someone to keep me healthy, to prevent the problem, and you know, give me longevity. And that's the kind of analogy that I would give to delegators, to say that those people are paying a financial planner to avoid the problem. You know, they don't want to pitch up at the financial planner and then find out they arrived because they've got a problem. They want to go and have a meeting every now and then to say, you're on track and everything's okay. That's why I'm paying you, is to make sure that I'm on track. And so I think that you know, the delegators, maybe it's also probably the oldest form of client and advisor relationship there is now. So I could be accused of bias to say, well, I mean, that's the thing I've known the longest, and maybe that's true, but I do think that is, I think a lot of people are afraid of money, and so even if they've got it and they saved well, they're afraid of making mistakes, and that's, you know, it's good to know that. It's good to know that you're afraid of that. Can you solve it through some education? If more knowledge would help you, then you should do that. But also, if you know that your hardwiring is that you're going to make a bad decision when you're under duress, then you should have an advisor. You should have that stabilizer or that equalizer that helps you, the objective person. And I'm smiling when you talked about, you know, even CAs need advice. So I mean, I've sat in many meetings with accountants, hedge fund managers, and the like, and often their spouses. and the spouse has set up the meeting, because they will say, and they'll look at me in front of their spouse and say, my hedge fund manager husband knows nothing about how to manage our money.
Yeah.
And so I'm here to make sure we're going to be okay, because if it's up to him, we might be extremely wealthy or extremely poor or anywhere in between. And so that's quite funny, is that it's not just about financial literacy.
Yeah.
There's a whole dynamic at play here.
Absolutely. When we look at managing money, we've got the technical side, the information and the knowledge, and that's great that you can learn. We also have that emotional side, and that's something much more difficult to manage, depending on how you've been raised around money, what your perceptions are, what you as a couple, how you think about money as a joint team. There's a lot of layers to making financial decisions. And sometimes it's where you and your partner maybe have different views on how money should be managed. To have a third person to give that objective opinion as to collectively how should we manage stuff. So I think that thinking partner is really adding value to. Sometimes it's not necessarily telling you what you're doing wrong. It's just to tell you will be okay. Because if you know I'll be okay, you're going to look at the world differently. You're going to make different decisions. Maybe you've really worked so incredibly hard your whole life, in your 50s, that you've got money, you've saved a lot, you've sacrificed a lot, but you still don't know if you'll be okay, because you don't know all the layers of calculations to do. And sometimes, advisor could tell you, listen, Mr. X, you can actually stop working today and you'll be fine for the rest of your life. That changes your life completely, because it now puts you in a position where maybe you were kind of scared to exit the career that you didn't like, to now being almost in the position to do that and to still be okay, and to someone to just show you, as deep as you want to see how the calculations look. But sometimes it's as simple as saying once a year, you're still on track, well done. You continue living life on your terms, and you can focus your time and energy on the stuff that brings joy to you, your family, your career, your community, instead of having those sleepless nights of knowing, because I think that's probably one of the worst things is not knowing what you don't know.
Yeah.
And someone to validate that, to say, I've looked at everything, you'll be okay. Let's take it from there.
So let's talk about when you're sitting there and you're unhappy.
Yeah. When to fire.
When to fire, because it's. I think also, just to say at the outset that it's a relationship of mutual respect.
Yeah. Yes.
So I can't tell you how many times, when I talk to people and they go, my advisor talks down to me. When I ask a question, they become defensive, or they become aggressive, or they become condescending, and I feel embarrassed to ask this question as if I should have known that. Or it's my husband's advisor, or it's my wife's advisor, or nowadays with intergenerational money, it's my dad's advisor, and they think, as a 30-year-old, I don't know anything, and they talk down to me. So there are very good times and very good reasons why you should find someone else to be your advisor. I don't think you should view it as a long-term relationship, and it definitely needs to be mutually respectful. But that's not a lifelong commitment. It's not a marriage contract. So there are times when it's sensible to say, we get to this point, but no further. We need to end this for a range of reasons.
Yes, yeah. And I think the one important thing, probably the most important thing when it comes to, I guess, any relationship, but specifically advisor-client relationship, is transparency. Because oftentimes it's the fee that comes up. And in the next episode, we'll unpack the different ways advisors get paid. But first of all, if you don't know how you're paying your advisor, or they don't want to tell you, it's even worse, that's a red flag. You need to know how much you're paying and also understand the value that you receive. If Mr. Advisor is adding a lot of value, then contact with you. They do the analysis once a year at least, and they continue making you feel comfortable about life and guiding you through all of the complexities and preventing you from making silly mistakes. You can then decide the fee that you pay and the value that you receive, does it make sense? And equate that to a rand value. But if Mr. Advisor sold you some product 5 years ago and you have not heard from him since, probably does not make sense to continue that relationship.
Why are you so vague? No, it doesn't. You should fire them and get rid of them. They just sold you a product. That's a salesperson. That's not an advisor.
Yes, you're a customer, not a client then.
Yeah, and you know, the law requires them to do a review of you once a year.
Yes.
And if you haven't heard from your advisor the only caveat is if you're ignoring your advisor's attempts to contact you to sit down and do a meeting, then that's on you. That's your deal. But if an advisor is proactively getting hold of you at least once a year and trying to engage and trying to have a proper relationship, not to just sell you another product, but to engage with you and to actually understand where you're coming from, that's the least that should happen. If you haven't heard from them, they haven't even sent you an email in the last few years, they should not be earning a cent from you. You need to either find a new advisor and end the one relationship that you've got, but that's not a good place to be.
Yeah, and I think kind of like the evolution of advisors. I guess let's be honest. When the term advisor was started, it's mostly a broker. It was a salesperson. It was designed to distribute products, and it has gone a long way since then. And there's actually now qualified financial planners that knows what they're doing, and they're doing financial planning. They're still brokers, and they still play an important role. But there's a clear distinction here. I think for me personally, when I would consult a financial planner, and by the way, even if I am a financial planner, I would still consider getting a financial planner, because just to double check myself, it is some of the points that I would look at is, if I meet someone for the first time, are they going to suddenly start trying to pitch me some sort of product and they quickly jump into the product discussion and want to find out everything about the money? Or are they going to spend some time to get to know me and who I am and what I want in life? I think that's very important for me, because that already shows me it's a preemptive look at how the continuous relationship will be like. If they're just interested in selling you something, you're probably looking at a transactional relationship where maybe you would be sold something and you're not going to hear from them. It's going to be at a very superficial level. Whereas if they take time to get to know you, you're probably in for the long term, and they are more interested in helping you reach your goals. And then yes, the products and the services and all of that will be on the back end of that. That will be as a result of a financial plan. But you can't give proper financial advice if you don't understand the person's situations, and you can't do an analysis if you don't get all the data. So I think it's important to spend time. And if you are in the market of consulting a financial planner, whether you are a DIYer that just want to validate stuff, or you are a delegator, consult different advisors, set up 3 meetings with 3 different people. And I always say, like, if you don't know at the end, go with the one that makes you feel the most comfortable. Because I think that relationship is the most important part of the success. And yes, there's qualifications and there's knowledge and there's experience, and all of them, those factors play a role. But I think relationship is probably going to be the most important factor for me.
I think when you realize that the relationship's not working is when you feel you can't ask them a question. If you're a client and you think, I can't ask my advisor how they get paid, or I can't ask them actually, you seem to work for one company and I only ever get that company's recommendations, like it's their product or whatever. Why is that? Like you should feel free to ask any question around your money. And they should be pretty upfront and transparent anyway. So almost before you're asking the questions, they should be telling you how this works, and they should be delivering on promises. So if they say to you, "We will speak to you twice a year. We're gonna, this is the deal," and after the first 6 months you haven't heard from them, don't sit back. Don't then feel I'm not sure now. I'm embarrassed. Or if there was an agreement, there was something promised to you, or an undertaking was made, and it's not being delivered on, ask the question. There might be a very good reason, in which case you should know, or it might be that you thought you were dealing with a proper advisor and you've ended up with a salesperson. So I think that it's about being proactive, and then also be fair. So if your advisor is saying to you, look, our relationship and the way we work and the way I'm going to charge you, I'm going to proactively speak to you once a year, but for the rest of the time, I'm happy to answer your questions if you've got, then don't get upset with them that they're not phoning you every 3 months. That wasn't the arrangement. So it's being clear with each other about what do you expect from me. So you as the client need to be clear with your advisor. This is what I expect. The advisor says, I'm happy, I agree with that, or I'm not happy, this is what I propose. And then those are the arrangements you should deal with. And sometimes the chemistry changes. So what you might find when you're younger, you're dealing with an advisor who's got more of an insurance focus because they understand life insurance and disability insurance and those kinds of things, which is possibly what you need earlier. And then when you're in your late 60s, you don't need that stuff as much as you need solid investment coaching or whatever it is. So you might find that that's also a time to change advisor, is that their expertise and your requirements are not the same anymore. No one's done anything wrong. It's that the nature of the relationship has changed. And I think maybe the other time to talk about when you should fire an advisor is if you're 65 and your advisor is 70, you need to ask some questions because I don't mind if your advisor and their younger 50-year-old colleague is around and you're 65, that's fine. But gee, if your advisor is 70 and their colleague is 82, that only works for Berkshire Hathaway. It doesn't work in any other company. You need to have, at later stage in life, you need an advisor that's younger than you. Early days, of course, then by all means take an advisor who's more experienced and has a breadth of experience that you don't have. But I think for me, those are the big things. And then maybe your advisor changes companies. It's a good time to ask why. It's not an automatic signal to fire your advisor. But at the same time, if your advisor is working for insurance company A and then they move to insurance company B, and then all of a sudden the next year you start getting recommendations for insurance company B's products and you only bought insurance company A's products 2 years ago, that's a massive red flag for me. I don't like it. I think it's bad practice. That's all about generating commission.
Yes.
So I think that would be a signal to fire an advisor.
Yeah, that's very important. They call it churning. So if your advisor every 2 years only phones you to tell you about these great new companies' products, and we're talking about long-term insurance, income protection, life cover, and then trying to sell you those products, and then 2 years later they switch you to another company, all that's really happening is they're getting upfront commission on that, and you will probably be worse off because you'll get older, you'll get health conditions most likely, there's loadings, exclusions, going to be more expensive, massive red flag. Sometimes advisors' value does not necessarily have to be expressed in the way of offering you new options. Most of the time, it's like saying, listen, we've spent a lot of time to put the plan in place. We're continuing with the plan. Every year we're revising it, but they don't have to prove their value by selling you different products. I think that's a flawed mindset to have. Sometimes it's as good as saying, you'll continue what you're doing, you'll be okay. And that's enough. So I think we're running out of time. We can probably spend hours.
We like this topic.
Talking about all the red flags. What is most important is understanding yourself and how you would want to engage with someone for advice. And there's no right or wrong with this. You can be a DIYer, try to do everything yourself. I think that's good for most people to build up to a level of knowledge that they're comfortable having and willing to have. But it does make sense to consult a professional, as with anything in life. You can eat healthy and exercise, but you're probably going to have to consult a doctor at some point with any health condition. That's kind of what we're referring to here. And if you would want to have a continuous relationship with an advisor and have that ongoing relationship, that's also great because that will probably allow you to live life without having to worry about money. Just make sure that you are getting value in excess of the fee that you're paying. And your advisor should be able to communicate and enunciate and have that full transparency as to what value do they deliver. And if it does get to a point where it doesn't work out, be transparent about it and seek different advice. That you're never locked, should never feel trapped into a relationship just because, it was my dad's advisor and his dad's advisor. And no, that's nonsense. You should get good value for the fees that you pay.
Thank you so much for listening. We appreciate it. And please don't forget to subscribe.
Thank you so much. See you next week. Bye.
The Honest Money Podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.